Good morning, everyone. Today is Friday, November 8th. I'm recording the October summary, and here we are very early in the morning in Arizona. Here for a couple of days attending a conference, but I wanted to get this information out. There's been a lot happening over the course of the last month, and certainly this week, as it was the election week. So I thought I would just fill you in on kind of where things are. Things that we've been tracking and whether there's been much change in that direction. As we've been saying for a while, as a lot of the data, especially the macro data, continues to look weak, we're either going to see a recession and the data continues to weaken until it just kind of drops out, or we'll see a soft landing, in which case the data should start showing some improvement and we'd be a bit more encouraged to step back in. Part of our defensive nature is many of our clients, many of you listening to this are retired. You have plenty of resources to achieve the retirement goals we need to achieve, as long as we don't do something stupid, subjecting ourselves to large market losses, especially when the data is so questionable. The other thing we would hopefully expect, regardless of the scenario, is a bit of a broadening out, where the concentration isn't just the Magnificent Seven. So let's take a look at the data. This was published just about 2 weeks ago from the conference board. You've seen this before. It's the leading economic index. It's an interesting macro because it has always foretold an upcoming recession with zero exceptions. And once again, for the month of September, reported in October, the data continues to weaken. It not only weakened, but the conference board also noted that the 6-month period ending in September was actually weaker than the 6-month period previously. So again, if this is a soft landing scenario, we would certainly expect to see that change. And you'll see within the box, the month over month data continues to weaken each and every month, certainly cautionary. We also talked about the yield curve. Yield curve has been inverted for quite some time. That also is a macro indicator and certainly suggests recession or credit problems ahead. The blue line is where we are today in November. It's flattish. The dark gray beneath was where we were just a year ago in November, and you'll see it was a bit more inverted. So what's happening is this thing's beginning to flatten out a bit as short-term rates are coming down and longer-term rates are coming up, which is a little bit strange, but that's kind of what's happening. With respect to that, it's usually after the yield curve flattens that we end up getting a recession. This slide also we've seen before. The blue line represents the credit spread, or the difference between interest rates long versus short. Usually long-term rates are higher than short-term, so that would be a positive number if you compared the two. Every once in a while, on rare occasion, short-term rates are higher than long, as it's been for quite some time, and that's an inverted yield curve. And you'll see on rare exception that happens, and anytime it happens, it typically leads to a recession. There's been no exception here in the last 40 years. But the recession doesn't happen at the time of the inversion. It happens when things start to flatten out, start to rewrite itself to a more normal pattern, which is kind of what we're seeing today. And then the last big macro is unemployment. The unemployment or employment numbers are really wonky. They're prone to huge revisions. Some people are saying you really can't just use as much value in the ADP reports, etc., because these are surveys, and apparently the sample size of those surveys have been coming down. There have been less participants. Also, the unemployment rate or employment is a lagging indicator, not a leading, so it really doesn't provide a lot of predictive opportunity. However, the rate of change, or the second derivative, does, meaning how quickly is this thing improving or weakening over a relatively short period of time. So the SOM rule compares the last 3 months of the unemployment rate to the lowest unemployment rate achieved in the last year. And if that spread is 0.5% or more, it typically indicates that we're right on the cusp, the outer left-hand edge of what will become a recession. So this chart hovers mostly near zero, which is that black line at the bottom, but occasionally it'll spike up. When it spikes up, gets up to about 0.5%, that's kind of right when we're looking at recessionary times. We violated that. We're up to those levels these days. Again, another reason maybe to be a little bit cautionary. So we talked about the LEI, we talked about the SOM rule. One of the reasons that everybody says the economy is quite good, two reasons. One, GDP growth is 2.5+%, came down a little bit here the last month or so, but it's still certainly much higher than you'd expect in a recession. And two, the consumer continues to spend. And we're continuing to see that. And part of that might be because the employment situation is still hanging in there. That said, it's really difficult to look at GDP at 2.5% when the government is deficit borrowing 7% of GDP to support that. So a significant amount of GDP growth is government spending, and it seems to be somewhat confusing that we have GDP growth at the same time we have deficit spending. Never happened before. So we'll see what happens here in the future as maybe some of that government spending gets challenged. On the consumer side, delinquency rates are rising. Consumer credit card defaults or delinquencies. And this isn't somebody just missing a payment because they're on vacation. These are people who are 90 days plus late. They're actively avoiding making payment. That's now nearly 11%, up from 8% just a year ago. At the very bottom, this is data that was released earlier this week. CMBS, those are commercial mortgage-backed securities. These are securities, kind of like the CMOs, those packaged products that we had during the financial crisis. This is the same type of packaged product. They hold a large number, a diversified portfolio of commercial mortgages. Think of those as the mortgages on large commercial office buildings. The delinquency rate is now 9.4%. That's the highest that we've seen since the financial crisis. It was less than half of that just simply a year ago. So you'll see what's happening in that regard. And it's up over a full percentage point in this last month. So that's certainly something to watch as well. There's certainly some trouble brewing with respect to those. We've talked about it for quite a while. We're now beginning to see it. On the manufacturing side, it appears that the manufacturing industry in the aggregate has been weak and probably recessionary for a while. Hasn't spilled over to service yet. The ISM numbers registered the lowest reading we've had this year. That was just this past month. Again, if it's better and soft landing, we'd see improvement, not weakness. And now we've had contraction in 23 of the last 24 months. Chicago Business Barometer dropped again, the single largest drop we've seen in several years. Dropped almost 5 full percent from the September reading. So again, that's something to consider as well. Jobs are really wonky. These numbers are prone to huge revisions. But if you look at the bottom set of data, most recent U.S. employment report came out Friday. Big surprise. The month before, the number of new jobs was something in the order of 200 and some thousand. I think it was 250,000 in September. And for the October reading, the thought was it was going to come in much lighter because of the dock strike as well as the hurricane. So the expectation was that was going to be some weak catalyst. So they were expecting the number to come in at about 100,000. That number came in at 12,000, a significant downward drop in new jobs created. And the other thing that collapsed was the number of new jobs available. That collapsed by several 100,000. So employers are retrenching at least a little bit. Month of October was generally a down month. S&P was down, NASDAQ was down, Dow Jones was down, Russell 2000 small cap index was down. And at the same time, bonds were down and down even more. Now remember, bonds go down when interest rates go up. And this is data through the month of October for the month of October. Now the really interesting thing there, and don't quite know what that means yet, but remember the Federal Reserve September 17th cut rates 0.5%, signaling that they're bringing rates down. And yet at the same time, bond traders are bidding bond prices lower and interest rates higher. That's also one of the reasons the yield curve kind of flattened a bit. So we have to kind of figure out what that's about. Is it one, they're demanding higher yields because they're worried that there's still inflation to deal with? Inflation ticked up. The PCE ticked up, I think it was 0.1%. Or is it this huge amount of debt that we're accumulating? And does that mean that bond traders want a higher yield because of risk of default or risk of some credit disruption in the future? We're not quite sure, but the expectation would have been rates should come down. And rates went up significantly after President Trump was reelected. Stock market rallied, but bonds got crushed. The aggregate bond index was off almost 2%. Huge move. That says something. Don't quite know as of yet. I continue to update the slide because this Magnificent Seven thing has been quite interesting and reminiscent of the dot-com stocks back in the day. But as you can see, they're still quite meaningful. They represent 32% of the S&P. In fact, the top 10 stocks in the S&P represent, I believe, 35%. Back in 1999, 2000, before the dot-com bubble, the top 10 would have represented 27, 28%. So things are a little bit stretched. In spite of the fact that the S&P was down, in the aggregate, the Magnificent Seven was up about 0.25%. If it wasn't for Magnificent Seven, the S&P probably would have been down a little bit more. And there you have it. That's kind of where we are. That's what's happening. Obviously, we had the election. We had a bit of a Trump euphoric rally on the equity side, a retrenchment or correction on the bond side. Generally, the experience is after an election, there's some degree of euphoria that lasts several days, and then you kind of get back into what's really happening with respect to the economy and a lot of the metrics. So there you go. We'll talk again at the end of this month, November. If you have any questions, please reach out, call me, email me, reach out to my team. Otherwise, have a great day, and we'll talk to you soon. Take care.